Hey everybody, this is George, and 2023 real estate, it's going to be super boring. And everybody is telling us the same thing. And so that is the exact prediction that we've got. So make sure that, let's hit that smash that subscribe button, and it allows you to be updated. Remember, hey, there's no selling in this. It's just really good information for when the time is right for you and your family. The goal is to give you real-time information, not stuff back in October, like we had to go through at the year-end stuff. So again, subscribe to the channel, and this way, if there is somebody out there that is needing to make a good decision, that algorithm out there between YouTube and Facebook and whatnot, they will go ahead and share that information, which is the best part. All right, so let's start with the normal. Where the heck are we with today's market? So when we take a look at that, you can see that we actually have some pretty good metrics. Now today it's January 7th, so this is technically up to about Jan 6th. So you can see that we actually have 640 new homes that came on market in the average of the last 7 days. With that, you can see that we've got 698 pending and 494, almost 500 closings just in the last 7 days. And so even though interest rates ticked up a little bit, really our market is still plugging right along. Now we're not making any land speed records, but all things considered, we're doing really well. Most important, when you take a look at the on market and just reduced, hey, listen, if you're a buyer out in today's market, and in fact, I was telling Carl this the other day. How you doing, Carl? Here's the thing. Those are great opportunities for you guys, all right? And you just gotta pay attention to them, because the seller lost their buyer. And that means that they're gonna be a little bit more motivated. And in fact, this morning, about 6 o'clock, some of my clients received a number of these homes that we monitor, and it just gives them a better opportunity, to get a good deal. Now, I don't like to call, clients deals, but the perception is they want a good deal, and that is a great way to get some additional deals in front of you, if you want to call it as such. All right, so as we take a look at that, you might say, you know what, George, hey, what's the market really doing? What are we really looking at? And, there's a lot of mixed information. We're going to get into Mr. Yoon from the National Association of Realtors, who's giving us some really good information. But you can see here from our chart, really at the end of the day, let me blow that one up for you. So you can see that our sales are up 23% for the first part of the year, even though our inventory is up here at 192%. Everything that you're looking at says, okay, so we're doing a little bit better than we did last year at this time. Not unexpected, because we saw some better pricing, both on the mortgage side of things and on the housing inventory level. Because again, as we take a look at the inventory numbers, you're like, oh my gosh, George, look at this. We're like at almost 3 times as much as what we were back in last year at this time. But when you take a look at the number here in October, where we were pert near 13,000 homes, and now we're right around the $9,000 mark, or 9,000 home mark, you can tell that we've been dropping down inventory. Now, part of that is seasonal, totally normal. But remember, go back and watch all of the prior episodes. You can definitely tell that we've been taking off. We had more pending than coming on market. We were drawing down that inventory. It's not that a lot of people canceled or expired and we're going to wait for the new year. Sure, we had that normal inventory that moved over until, as you can see, we've got a few more coming on today. So with that, we've still been drawing down inventory. Now you might say, okay, George, if we've got this chart here and it is showing that, oh my gosh, we have a lot less than we did last year, but let's take a look at the average of the last 15 years. And when you take a look at that, and this being 2008 at the beginning of the chart, 2022 at the end of the chart, you can see that other than 2020 and 2021, which were aggressive markets just based on lack of inventory, as you can see the light green and the dark green, but there's nothing crazy about, oh my gosh, our sales are like way down. No, we're right in the middle. We're right in the middle, and interest rates have actually started to balance out. In fact, what's super interesting is, we've been saying that in Q1, first quarter of this year, and more towards, I think, the latter part, February will be interesting to see what shakes out. It just depends on some of the metrics, even though the Feds, I don't think they're going to do their 75 basis points, 0.75% increase on Fed rates. So remember, Fed rates, right? They do not control mortgage interest rates. Okay, they control day-to-day lending between banks, your home equity line of credit, if it's not fixed, which most of them are not, your credit cards, and when you take a look at car loans and things like that, short-term debt, that is what they control, not long-term, like mortgages. All right. So with that being said, we've got the Feds, which I think are actually going to be, I think they're going to actually be modest. Sure, the recent employment numbers, well, that's not going to make the Feds feel very happy because the employment numbers actually came down, although that's not a 100% accurate number that they've got there. But what do I know? They get to report however they want to their statistics. That's fine, whatever. So let's take a look at what we've got here, and we talk about Seattle itself as far as a ranking within the financial industry, right? So when you look at this, Seattle actually, as far as the overall financial health, we actually, as you can see, we had number 23, but really we were number 8 in a lot of municipalities. Seattle, Tacoma, Bellevue, the east side and whatnot, all things considered, financial for the overall economy, doing really well. Now, sure, we did have some announcements that we've got some additional layoffs. Redfin is doing some more layoffs. Zillow's doing some more layoffs. A lot of, Compass is doing a crap load of layoffs. Amazon is doing a bunch of layoffs, right? Okay. There are still a lot of positions out there that will be available for these people, depending on what industry they're in and what they're doing. But, all things considered, stability-wise, we're still doing incredibly well. There's still a lot of great options out there. And so when we kind of bop into our next slide here, my favorite, my buddy, we have Mr. Yoon. Lawrence is the chief economist for the National Association of Realtors. He is a super smart guy. I've had the opportunity to chat with him personally. What a humble individual. I mean, truly, a very humble guy, and super smart. And it is fun to go back and forth based on different things. And it is shocking because he does things across the United States. I deal with a very local market here in the Puget Sound area, and working with 11 banks and whatnot on a daily basis, providing information. Here's the funny thing, right? He knew very much about our market area. And that just shocks me because, and it's not just, generic information. He really actually dialed down, even as deep as we go each and every week with our metrics and with our clients. Not as deep here, but still pretty deep. And I was, again, just super awesome guy. All right, so let's come over here. So what does he say? He also predicts that mortgage rates are going to drop into the mid to upper 7 or 5s this year, down from a high of 7.8%, 7.08, I should say. Along with that, a return to normalcy as far as a market, albeit even he predicts a tad bit boring. And why? it needs to be boring. Why does it need to be boring? It needs to be boring because we needed to get our market back into what we consider a stabilized market. They're figuring that 2023 will be a stabilizing. That means that half the country will probably see some price increases, while the other half of the country is going to see some price decreases. No kidding. I don't know why I always thought that was kind of funny. Well, half the market's going to go up, half the market's going to go down. We're going to be net zero, meaning super boring. Okay, so it's like us. And it's funny because I was having a really great chat yesterday, and they were talking about, and in fact, this was with Mario, who does a lot of painting, sheetrock, and whatnot. And we were talking about new construction, what new construction is doing, and the difference between urban and, basically kind of a little bit more rural. The more rural areas, RURAL areas that are a little bit farther out, those prices, those homes are suffering a little bit on price, and not unexpected. Why? Well, because as you're seeing fuel prices go up, it is, I guess, a fuel crisis. Anyway, inflation going up, people are, seeing less money that they get to keep in their pocket, which is a real bummer because the government should let you keep more so that you could spend more, which keeps the economy going. But that's above my pay grade. So with that, some of the Lake Stevens, some of the Monroe areas are taking a wee bit of a price hit on new construction, whereas in the more core areas, they are actually still seeing some multiple offers, very few cancellations, and homes that are selling, at list price and or getting, a number of incentives. Okay, there's still a massive shortage of homes available for the influx of folks coming into the area. Now, I'm not talking about what's going on at the southern border, people coming in. I'm just talking about just generalized people coming into the state, into our counties, into our cities for employment, for relocation, whatever it is. We're still seeing that massive increase of people still coming in. And again, we're still, I think, 1 million homes short or something like that of where we really need to be. Anyway, with that being said, let's move on. So as we take a look at our next chart here, for Mr. Yoon, long-term housing deficit is unlikely to change anytime in the near future. When we talk about, or unlikely to change, when we talk about actual inventory, the increase in cancellation means builders have got to be more prudent, cut back on some of their production. Now we just talked about part of that. That is not as much. We're not seeing that much in our areas. We are seeing it in other states, and I hear that from some of the other real estate brokers like Lester Cox, having a great chat with him down in Arizona. Super interesting to see what's going on down there. We are not experiencing a lot of that. Our inventory technically is at around 2 months. They say that 4 to 6 months of inventory is a balanced market. I really think that this is going to be our new norm. We have seen this new norm really since about, I would say about 2013, 2014, when we really started drawing down inventory, when we had a lot of industrial investors, a lot of move-up buyers renting their house or buying a rental home, things like that. Started drawing down that inventory. We've never quite recovered since then. So that's one of the reasons that we will continue to see our prices seeing a much more stable level, because really, as we head into the spring market, and in fact, we will start to see those numbers change from the 198%. We're going to see that they're going to actually start to show normalcy, because we've gone from horrific numbers, historically never have seen numbers in like 2,500, 2,300, 2,800 homes, boom, to 8,000 homes. And you might say, oh, that's amazing. No, we should have 18,000 homes, 22,000 homes. That's our normal. That's what we've historically seen. And we have not seen those numbers in a long, long time. If we go back, I've been practicing for 30 years. We go back and we take a look at those numbers, because as, hang on a second, let me pop back here real quick. Oops, that one. So when we talk about, and we see this, the green numbers here back in 2000, if we exclude 2008, 9, and 10 and just start with really 12, 13, 14, which is a normal, this is normal for us. 2011 was a little much, okay? You can see the light green that is normal for us. And then we started drawing down. 2017 was a crazy market, at least what we thought at that point. Dwarfed, absolutely dwarfed by 2020 and 2021. But historical, as you can see, from about 2014 on, 2013 on, that is a normal inventory level, and we haven't been seeing those in a long time. So this might be our new norm. Anyway, moving on. So let's move our slides back to here. All right. So when we talk about rates, today we're looking at rates at about 6.48%, which again, that is super awesome because we're drawing that down. I am predicting, even though we bumped up the last couple of days, our interest rates have kind of done incremental upward trend. I expect these to come back down and into the fives. And when that happens, for all those buyers out there that have been waiting, you and about, I don't know, a couple of 10,000 of your best friends are going to come out to the market with you. So really, if you're a buyer, I would start looking now. But super important. This is what's super important. Hang on a second. I think it's my next slide here. Look at this. Let me take my face off here so you can read the whole thing. Look at this. The important one is the bottom one. Beginning of March, Freddie Mac will require first lien mortgages to be at least 12 months old before you can cash out and refinance. That is a massive step. And I have a sneaking hunch they've been watching my channel and saying, hey, these guys are going to refinance. I'm kidding. They're not. They don't know who I am. But anyway, they should, because I give great information. Remember, like and subscribe, right? Anyway, here we go. That means, and this is a big game change, that for folks that are looking at, buying a home and refinancing, which one of the tactics that we're talking about, that ends in March. That's a big deal. So you have an additional incentive to secure your home now so that when the rates do come down, that you can capitalize on it. Otherwise, in March, you buy a home, you got to wait for the following March before you can refinance. That is a huge change. And you need to be super aware of this, because that puts a timeline for you to look at and secure a home with better interest rates. Otherwise, the 2-1 buy downs, doing interest rate buy downs and whatnot, probably are going to be an incentive for you. Although our rates, again, I think they're going to stay in the sixes. They'll probably pop up into the sevens temporarily, but I think they're going to stay in the sixes. Short term, we're going to drop down into the fives. Mid sixes is going to be normal. That's where we normally are anyway. Between high fives and mid sixes, that's a normal interest rate anyway. It's not like it's some, oh my gosh, it's so high. It's not. That's normal. Anyway, moving on. So let's take a look at our next chart. Oh, that's it. Oh, that's right. I wanted to get back to that one. Hang on a second. So we had our normal, reduction in mortgage applications. That is totally normal. And then, of course, cash out refinances are going to have higher fees, because they use those fees to help balance against other borrowers and whatnot, to help balance the cost of funds and everything else. So not unexpected. All right. Super important information today. Basically, 2023, as predicted, and as others are saying, hey, listen, it's going to be relatively flat. It's going to be relatively boring. Okay, no big deal. Expected, right? We're going to see some price increases in some areas, some price reductions in others. Aggressive sellers are going to sit on the market. Well-priced sellers are going to go off the market. And just keep that in mind, that when it comes to March, you will not be able to refinance your Freddie mortgage for a year. Now, Fannie hasn't followed suit yet. HUD hasn't followed suit yet, but I guarantee you they're going to. It's coming. And so you just need to keep that in mind. With that, remember, all of your loan programs have changed. Okay, so our conforming in Pierce, King, and Snohomish County for high balance is $977,000. That means you can add 5% to that. That's $1 million. That's $1 million home. You can buy $1 million house with 5% down now. Who would have thought? Anyway, keep those numbers in mind. Make sure to like and subscribe. Hope you guys found today helpful. Make sure you ask those questions. We love questions. And again, there's no selling here, so it's just really great information, and we'll provide you that really great information. And if you want our year-end 2022 market update as to how we did and January's stats as to where we're seeing things going, again, just post it. We'll send it to you. There's no strings attached. If I do not have the ability to send it to you by text or by email, think about how you want me to get that to you. That's it. In the meantime, you guys have an absolutely beautiful day. I'll see you on the next video. Take care.